Principal investments in the banking sphere, exploring investment strategies and their effects. Agenda: understanding principal investments, types of principal investments, strategies for principal investments, regulatory and compliance considerations, impact of principal investments on banking operations. Definition and scope of principal investments. What are principal investments? Principal investments involve direct capital investment by banks into various securities or assets, aiming for returns. Types of investments. Principal investments can include securities, debt instruments, and other financial assets that yield returns. Return expectations. The primary goal of principal investments is to generate substantial returns on the invested capital over time. Differences between principal investments and other investment types. Principal investments defined. Principal investments involve banks using their own capital, distinguishing them from agency investments. Risk profile comparison. Principal investments carry a different risk profile compared to agency investments, affecting decision making. Return expectations. Expectations for returns on principal investments differ due to the capital used and associated risks. Importance in the banking sector. Revenue growth support. Principal investments play a crucial role in driving revenue growth for banks by generating returns and income. Capital for lending. Investments provide banks with essential capital that can be lent to customers, facilitating personal and business financing. Financial stability enhancement. A strong portfolio of principal investments enhances the overall financial stability of a banking institution. Types of principal investments. Equity investments. Understanding equity investments. Equity investments are purchasing shares of companies in exchange for ownership stakes, leading to potential profits. Potential returns. Investors in equity can benefit from capital gains and dividends, making it an attractive investment option. Risk and reward. While equity investments are often higher risk, they can also offer substantial returns for investors willing to take the chance. Debt investments. Definition of debt investments. Debt investments refer to financial instruments like bonds that involve lending money to entities in exchange for interest. Interest payments. These investments typically provide regular interest payments, making them a reliable source of income for investors. Lower risk profile. Debt investments are generally considered lower risk compared to equities, appealing to conservative investors. Hybrid instruments. Definition of hybrid instruments. Hybrid instruments are financial securities that possess characteristics of both equity and debt, offering a unique investment vehicle. Risk management flexibility. These instruments provide banks with the flexibility to manage risk and returns, enhancing their financial strategies. Strategic asset allocation. Hybrid instruments facilitate strategic asset allocation, allowing for optimized investment portfolios tailored to market conditions. Risk assessment and management. Importance of risk assessment. Conducting risk assessments is vital for banks to identify potential pitfalls in their investments, ensuring financial stability. Evaluating market conditions. Evaluating market conditions helps banks understand economic factors that could impact principal investments and overall performance. Credit and liquidity risks. Assessing credit risks and liquidity factors is essential for banks to manage their capital effectively and safeguard against losses. Portfolio diversification, risk management. Diversification helps in spreading risk across different asset classes, reducing the impact of any single investment's poor performance. Stability improvement. A diversified portfolio enhances stability and resilience against market fluctuations, leading to more consistent returns. Potential returns. Investing in a variety of sectors can increase the potential for returns over time, maximizing growth opportunities. Exit strategies. Importance of exit strategies. Clear exit strategies are essential for managing principal investments effectively and ensuring financial success. Maximizing returns. Investors must understand when to liquidate to maximize returns while minimizing potential losses. Minimizing losses. Effective exit strategies help in minimizing losses during market fluctuations and investment downturns. Key regulations affecting principal investments. Basel Framework. Basel is an international regulatory framework that sets capital and liquidity requirements for banks to improve financial stability. Dodd-Frank Act. The Dodd-Frank Act was enacted to promote financial stability by reducing risks in the financial system, specifically for banks and financial institutions. Importance of compliance. Understanding these regulations is essential for banks to ensure compliance, avoid penalties, and enhance strategic planning. Compliance requirements, regulatory compliance. Ensuring compliance with regulatory requirements helps banks operate legally and effectively manage risks. Risk management. Compliance requirements assist banks in managing risks associated with principal investments and protecting stakeholders. Reporting obligations. Banks have specific reporting and disclosure obligations to maintain transparency and trust with regulators and stakeholders. Impact of regulatory changes on investment strategies. Regulatory influence on investments. Regulatory changes can lead to a shift in investment strategies, impacting decision making processes for banks. Agility and adaptability. Banks need to maintain agility and adaptability to navigate new regulations while optimizing investment portfolios. Impact of principal investments on banking. Revenue generation and profitability. Principal investments provide essential returns that contribute directly to a bank's overall revenue, impacting financial health. Portfolio management. A well managed investment portfolio is crucial for enhancing a bank's profitability and ensuring sustainable growth. Influence on banks' balance sheet. Asset representation. Principal investments are recorded as assets on the bank's balance sheet, showcasing their financial significance. Impact on leverage. These assets directly affect the bank's leverage, influencing its ability to take on additional debt. Capital ratios importance. The relationship between investments and capital ratios emphasizes the need for prudent investment choices. Conclusion. Importance of principal investments. Principal investments are crucial for banking operations, driving growth and providing strategic opportunities. Revenue generation. These investments contribute significantly to revenue generation, essential for the bank's profitability and sustainability. Understanding complexity. Grasping the complexities of principal investments is vital for effective banking strategies and operations. Thank you.